You walked into your bank, signed for your mortgage, and before you left, life insurance, disability coverage, maybe critical illness. They offered you protection. It felt responsible. It felt like the right thing to do. I want to show you exactly what you purchased that day, and more importantly, what you didn't. By the end of this video, you'll understand why the insurance your bank sells you and the insurance that actually protects your family are two fundamentally different products, and why that difference has cost Canadian families everything at the worst possible moment. Let's start with something the bank's insurance representative is not required to tell you. Bank sold insurance in Canada, the kind attached to your mortgage or offered at the branch, is what I call shelf coverage. It's prepackaged, standardized, and designed to fit the bank's process, not your life. Here's the embedded truth. When you buy mortgage life insurance from a bank, the beneficiary on your policy is, in most cases, the bank itself. Not your spouse, not your children, the bank. Your family receives a paid-off mortgage. The bank receives the payout. Those are not the same thing as your family receiving money and choosing what to do with it. Read that again, because most Canadians sign that document without anyone explaining that sentence. Let me show you the contrast directly. Bank mortgage insurance is decreasing coverage at a fixed premium. Your mortgage balance drops every year. Your coverage drops with it. Your premium stays exactly the same. A personally owned term life policy is level coverage at a locked premium. The amount your family receives never shrinks. The cost never quietly shifts. One product protects the bank's asset as it decreases in value. These are not variations of the same product. The other protects your family's future regardless of what you own. They are built for two completely different purposes, and only one of them was built with your family in mind. Stop here for a moment, because the next part of this video is the section most Canadian finance channels completely avoid. 3 words: post-claim underwriting. If you've never heard them together, what comes next will permanently change how you read any insurance document you've ever signed. Bank mortgage insurance in Canada, in many cases, uses post-claim underwriting. This means when you apply, they ask you almost nothing. No detailed medical history, no exam. You're approved quickly and easily. But when a claim is filed, when your family actually needs that money, the insurer reviews your full medical history at that moment. If they find anything a pre-existing condition, a medication you were taking, a diagnosis you had before the policy started, they can deny the claim. You paid premiums for years. Your family filed a claim, and the insurer decided your eligibility after the fact. That is not a hypothetical. That is a documented pattern that has appeared in Canadian court cases and financial ombudsman complaints for over a decade. This is what I call paper protection. It looks real. It's listed in your benefits. It feels like coverage. But it only gets tested at the worst possible moment, and sometimes it fails exactly then. You're probably thinking about the conversation you had at the branch. Maybe they were friendly. Maybe it felt thorough. And maybe, if you're being honest, you signed because everything was happening at once. The mortgage paperwork, the stress, the excitement. It was one more checkbox. Here's what I want you to understand. The person who sold you that policy at the bank is not a licensed insurance advisor in most cases. They are a bank employee trained to offer bank products. They are not legally required to compare that product to anything else in the market. They are not required to tell you better options exist. As a licensed insurance professional, I am. That difference in obligation is the entire reason this channel exists. So what does your bank actually sell you? A product that protects their mortgage, underwritten on your worst day, decreasing in value while your premium holds steady. What do you actually need? Coverage owned by you, paid directly to your family, underwritten once honestly before anything happens. The Canadian insurance market has dozens of independent carriers competing for your policy. Your bank has one shelf. You deserve the whole market. I'm not here to sell you anything in this video. I'm here because most Canadians are making a $500,000 decision based on a 5-minute conversation at a bank counter. And nobody in this space is saying it clearly enough. One question before you go, and I want your honest answer below. When you got your mortgage, did anyone at the bank explain the difference between their insurance and a personal policy? Yes or no? The answers I get tell me exactly what Canadians are still up against. Cover IQ exists for one reason: licensed truth over polished sales. Subscribe because next video, we go deeper into term versus whole life insurance in Canada. The math Dave Ramsey never showed you.